Good evening. And firstly, thank you so much for joining this webinar. And we welcome you to the webinar where we intend to discuss the changes in the draft income tax rules and the forms that have been put up for public comments. What we will do over the next 45 minutes or so, and then probably take some questions, comments, etc., is highlight only those aspects which we believe have significantly departed or changed from the existing rules or the existing forms, which either require greater disclosure, a different approach, and not really focus on things which are the same, which continue to be the same. While the Income Tax Act 2025 was passed, enacted, what had not happened was the rules were not notified, and there was a clear statement that the rules would be put out for public comments, and thereafter rules be brought into force. And we've, in my view, got sufficient time. Maybe 15 days would have been too short, but then we've got time for us to absorb this and comment on what changes are there. There are not actually too many changes, but there are some which are have a huge impact and are significant. We've split the changes into certain buckets. We will talk of employee taxation first. There are some changes there. Then what impacts profits and gains of business or profession, and certain things on treaty benefits, foreign tax credit, etc. And then the income tax return, and followed by assessment, appeal procedure, and the transposing aspects relating to the changes in the rules. What this is something, again, what we just discussed. The draft rules clearly aim to simplify the language and structure, remove redundancies, rationalize procedures. These are the stated objectives. And I think it does achieve some of these. The language is definitely simplified. There are a lot of tables, a lot of things which have changed exactly in line with how the Income Tax Act 2025 approach was. But there are some things which have crept in because of oversimplification, which we will discuss over the course of this webinar. What are the key things that are changed at a headline level? There is a significant increase in the perquisite valuation values. We'll go through that. There is a very important mandatory India-based books of accounts maintenance, absolutely relevant and critical for multinational enterprises and subsidiaries of MNC groups which are using common ERPs, etc. And I'll discuss what that means. The tax audit form, which was 3CA/3CB plus 3CD, have been merged into one single consolidated form. There are some additional disclosures there, and we'll get to that. There are some expanded disclosures in transposing in the 3CEB form, foreign tax credit, which now comes with a CA certificate on SFT and FATCA, which is specified financial transactions. There is a time-bound APA framework. The rules for APIs, HEFABA, etc. have been proposed. There's enhanced crypto and the CBDC reporting may not be too relevant, but we'll not spend too much time on that. The ITR one has been relaxed. There are a few things which have been eased, but there are certain stricter norms for defective return. What becomes a defective return, and that's very important. The TCS TDS processes have been aligned with the new Income Tax Act and few other things related to that. These are the things that we will discuss. On employee taxation per se, the draft rules firstly propose to include Hyderabad, Pune, Ahmedabad, and Bangalore for considering the 50% of salary for computing HRA exemption. What it does in short is that the HRA exemptions become attractive for the cities, the higher exemption, which also consequently leads to the old tax regime becoming more attractive. Employees would have done that analysis and chosen the old and new, and therefore for the subsequent year, for people who are doing it for the first time, will have to redo this exercise because the HRA exemption now looks completely different for these four cities. What it also comes with, and this is extremely critical for all employees and not just these four cities, is the draft form 124, which is equivalent to the 12B of the current form, which is the form that the employee has to give to the employer, now has a mandatory disclosure of the relationship of the employee with the landlord. As a lot of you would be aware, the income tax department had been targeting those cases where rent is being paid to parents, spouse, etc., and then HRA exemption being claimed. Rent agreements were called for. Companies were issued notices under and proceedings under 201 have been are in progress, have been taking place. So now this has been brought into the form. Extremely important disclosure. The relationship between the employee and landlord needs to be disclosed there, and the employer has to also collect the HRA agreement. So the moment the relationship is disclosed, I think companies could take a safer route of excluding certain immediate relative payments. Again, this depends on each company and their approach to compliance. If the recipient is offering to tax, is there really a impact, and is there a tax planning, and therefore from a letter of law is there a non-compliance? I don't think so. But having said that, you don't want companies having policies which permit these kind of things. So this is an important thing. Again, requires companies to relook at their whole HRA policy and how rent payments are being considered. There is a significant change in the perquisite valuation for employer-owned cars, where earlier the perquisite value for less than 1.6 liter engine was about 1,800 rupees a month. It's straight away been taken to 5,000, and 2,400, which is for the larger cars, has been taken to 7,000 per month. In case the motor car is owned by the employee, the reimbursement in excess of the above limits is considered taxable. Therefore, this is again an important change. Does completely impact how taxability of leased car perk, car being provided by the employer was being treated. And these numbers will change practically from the next 2 months, as we end 31st March and from 1st April itself. These are two significant changes in employee taxation. As regards business or profession, this I think is one of the most important changes. There is a rule that has been brought in which requires books of accounts which are maintained electronically to be accessible in India at all times. And it importantly brings out a clause which says that the backup must be stored only on servers which are physically located in India, and that backup must be updated daily. Therefore, today, if there is a centralized ERP, the data is being served elsewhere. The first point, of course, is met always, that it is accessible in India. The backup being stored in India, whether it's happening or not, needs to be seen. If it is cloud, the rules say that the server can be situated anywhere, but the backup will have to be accessible from India, and backup will have to be taken on a daily basis. Therefore, it's time for companies to get their IT teams involved to see what's been the policy, what their ERP does today. This becomes extremely critical. Both these aspects are new rules which have been brought in. The rule 6F, which was on maintenance of books of accounts, did not have these clauses, but these two have been introduced in the corresponding new rule that's been brought in the 2026 rules. Again, the books have to be maintained for 7 years from the end of the tax year. Earlier, it was 6 years from the end of the assessment year. So while 6 has changed to 7, the time period does not change, because the 7 is from end of tax year, while the 6 was from the end of the assessment year. Now, if you see the box on the right, this is how the 3CD new clause, the 3CD equivalent, which is Form 26, pardon me, during the course of this presentation, I'll still keep using the existing rules and existing forms till we get used to the new rules. But the Form 26 is the 3CD plus 3CB equivalent. Clause 14 of that requires address where books are maintained. The accounting software used for maintaining a book of account in the computer system needs to be maintained in Clause B. Clause C talks of details of any cloud or other software used for storage of books, along with location with the IP address of such storage. Clause D is whether provisions of Rule 46.8 have been complied with. 46.8 is what you see on the left side of the screen, which is whether the backup is in India and if it is being updated daily. Therefore, it's not only important for the backup to be done here, but your tax auditor will actually have to comment and confirm that in the Form 26. So 14D actually requires a confirmation from the tax auditor as to whether these rules of server being physically in India and backup being taken daily is being complied with or not. Clause E is again interesting, that if D is being complied, then the address of the location where the backup server is located in India. So I think the way I look at it is this government has been very clear about data localization. And I think this is an extension of the same thing in the tax laws for the accounting data of companies which are assessed to tax in India, which are taxed in India, for them to be maintained here. The fact that this has been brought into Form 26, i.e., the Form 3CD equivalent, makes it extremely critical and important. And this is something which then becomes a non negotiable for us going forward from April 1. So the takeaway here is for really for us to get back to check where our data servers are today, where the backup servers are, and whether a daily backup of the accounting is being done or not. My sense is the daily backup would actually be happening. I don't think anybody would be taking a risk of not having the daily backup. I'm not sure of where the cloud server accessibility is there, whether the backup servers are located in India. This is something that we'll have to go back and check. So these are some things that we discussed on the additional disclosure on backup server, etc. The other disclosures which are changed in Form 26, which is really from the fourth bullet onwards, is the MAT and AMT credit utilization. The credit utilization of MAT and AMT were not in the tax audit report. We did not have to show how much being utilized which year, etc. I guess they have brought this in because there is a MAT credit that's being allowed to companies which move into the new regime for a limited period of time, and up to a particular amount, as announced in the budget proposals earlier this month. Therefore, this sort of fits into that announcement. The other extremely important change that's come in 3CD is there's a separate section added which requires disclosure of the impact of any qualifications in the audit report. The change that is there, the paragraph and a table that is there, actually requires the tax auditor to quantify as to what is the impact it has on the profitability of the company, taking into account the qualification that's been given by the statutory auditor. This again is something that we were not used to. In fact, this in the past, when MAT was at its peak, was used as planning by some of the companies where we relied on Apollo Tires and such other Supreme Court decisions to say that the income tax officer cannot disturb the profit disclosed by the audited accounts. And therefore, even if there's a qualification or anything, no disturbance can be done other than those prescribed by 115 JB. So we were not adjusting the book profit for qualifications ever. This seems to be a departure from that. There is no change in the law. There is nothing that permits them to make the adjustment for qualifications. But I think it's interesting that they're collecting this information and they're also getting the tax auditor to certify and comment on it. The last change which has come in 3CD, which again becomes important, and we'll spend a few minutes on this, is there is now a requirement to disclose foreign remittances not subject to TDS under the Act. The table is as appears on the screen, which is nature of remittance, the number of transactions for such remittance, and the total amount of remittance in clause C. And there are two other columns, which says amount not chargeable to tax out of the amount mentioned in C, and amount chargeable to tax out of the amount mentioned in column C. Now, interestingly, this disclosure is only in relation to what is in part D of the earlier 15 CA, which is now 145. If you remember, there are four parts. The first part is for remittances, which is taxable but does not exceed 500,000 rupees or 5 lakh rupees. B is for what is taxable and it does not exceed 5 lakh, but then a 195(2) certificate has been obtained from the assessing officer. C was always for those which are taxable under the Act, and then there is a 15 CB obtained which shows what is the amount to be disclosed. D was remittances not taxable under the Act. In cases of certain payments, like there being no FTS clause, subscription or royalty, or no make available, or software payments, there were varying practices of showing it either under Part C or D. We believe the right approach would have to show it under Part C to say it is taxable under the Act, but it is not taxable under the treaty, and therefore there's no withholding, rather than show it as not taxable under the Act. Now, the new disclosure under 3CD is only for those which are falling under Part D and not under Part C. Therefore, it becomes imperative for companies to collect and actually have the information relating to what is being proposed under D. While all of this data was available with the tax office. The tax office would always get the 15 CSEB data from, once we filed it with the banks, once it was available, once we have uploaded it, all the soft copies available, the tax officers, the TDS officers would get access to that through insights reports and other things. Therefore, if you've seen, you would have got a notice under 133(6) leading up to a 201 to say you made this payment, give me a list of all 15 CB and things like that. Now they have actually shortened that process by actually giving this list in the 3CD itself. So the new 3CD, which is 126, requires the tax officer to disclose all foreign remittances where the amount is not taxable under the Act and the TDS has been done or not done, and the amounts also have to be disclosed. Therefore, where this is one part of it. Second is now we come to a situation where certain payments were taxable under the Act, but not taxable under the treaty like we discussed. Whether those needs to be disclosed or not is something that's not very clear. If you strictly take the reading of the Form 126 as it exists, it only requires those which are not taxable under the Act. Therefore, those which are taxable under the Act, but because of treaty we have got out, should it be disclosed or not? First blush, my response would be that you don't need to disclose that because it is still taxable under the Act. But since you have not withheld tax, there may be a need to disclose that. We'll have to just wait and see if after some representations, etc., if this will be clarified. But this one bit changes a lot of the data gathering and what you'll be giving, what disclosure you'll do. And therefore, the risk profile for cases where we are not deducting tax going forward, because these will all be available to the tax officer in one place. It's almost a lot more detail than what we were otherwise giving in 40A1 and 40A118 disclosures that were there in the 3CD. The central action plan, which was released both for the previous year and the year before that, requires the tax officers to see that particular clause. Therefore, I'll not be surprised if for the next year, the field officers are instructed to focus on this disclosure and issue notices where TDS has not been affected on a foreign payment. On treaty benefits and foreign tax credit, there are a couple of very important changes. The existing Rule 21AB, which talks of the 10F and what happens where 10F is not available, actually has two parts to it. One is the following information shall be provided in 10F, and the sub rule 2 says the SSE may not be required to provide the information or part thereof referred to in sub rule 1 if the information or part thereof, as the case may be, is contained in the certificate referred to in 94, which is nothing but the TRC. Therefore, if the TRC has the information that was required under 10F, we did not need to obtain 10F. But look at Rule 75, which is corresponding to 21AB. First part, it says that for the purpose of claiming double tax relief mentioned in so and so and so and so, the other documents and information to be provided by the SSE shall be as per Form 41. Form 41 corresponds to the existing 10F. Sub-rule 2 says the SSE shall keep and maintain such documents as are necessary to substantiate the information provided in Form 41, and the income tax authorities may call for the said document to verify the claim of relief. Firstly, the draft Rule 75 does not propose the relaxation. Accordingly, even what is in Form 41 would be mandatory, even if TRC contains all the information. This again changes a lot of things operationally. This is one aspect which we as Tax Compass are very clear to make a representation to say that the exclusion or the carve out, if the TRC contained information, has to be extended even for Form 41 to say that if the TRC contains all the information that you need, exclude us from getting a Form 41, because all that you are doing with the 10F/41 is to collect information of the foreign company, which I'm giving you by way of a TRC. So this is one aspect where we propose to make a representation. The second change is Form 41 proposes a requirement for a communication address in India. This could actually be difficult for foreign companies without presence. Today, we are having 10F where actually no India address is being given. We are having some difficulties on OTPs in certain cases for certain countries, but still we are not struggling with an India address. This is the second change relating to 41 and 10F, which needs a relook in our view. Therefore, this is also an aspect that we will be covering. Both in our view impact operational things of payment to foreign vendors. If it poses a challenge in related party transactions, in unrelated party transaction, in third party transactions, this is going to be a nightmare to obtain all of this from companies which we don't deal with on a regular basis. There is a change in the entire foreign tax credit rules and regime. One is that the draft rules proposes requirement for verification of Form 44 by an accountant, one in all company cases, and in cases where foreign tax paid outside India in a year equals or exceeds 100,000, 1 lakh rupees for individuals, non-companies, could be all other cases other than companies. Therefore, as corporate taxpayers, we will definitely be required to obtain a Form 44 by an accountant. Therefore, the FTC, which was otherwise being claimed by filling the schedule in the return, today requires a chartered accountant certificate. What it also does is the computation mechanism for FTC now is under a scrutiny by the accountant, and therefore companies were following slightly varied methods, and rightly so, because there are no rules today which govern how FTC has to be computed. FTC was being claimed on gross basis in some instance, net in some instance, and I don't think there was anything wrong in that. Courts have also allowed both different basis, and we could use which gave us a good outcome in that year. Whichever method was beneficial was being followed, but the draft Form 44 prescribes that the FTC has to be done on a net income basis. There is a note 6 to the Form 44, which says that this amount is to be net income within brackets gross income minus direct expenses and pro rata indirect expenses in connection with the gross income, which is included in total income assessed to tax in India. Interestingly, there is no rule which actually talks of net income basis. Therefore, if we go purely by first principles, a firm cannot dictate or change what's in the law, including the rules. Therefore, what's in the rules will prevail, which really means that we will still have the option. But how this note will be read by the accountant issuing Form 44, etc., we will have to see. The method of computing the FTC actually emanates from the DTA and the Act read together. Therefore, guidelines mentioned, the notes mentioned in the form will not and should not override those provisions. But this is again an area of that requires some bit of representation, explanation to say that this note sort of really leads to a situation where the tail is wagging the dog. And these are not things that we should be really be fighting about and litigating, because we know how this goes. These are the things which will lead to litigation, where a tax officer tomorrow will come back to say that there is a note which is there in the form which says that it is net income and therefore we have to go on net income basis. This has a huge impact in cases where we are having TDS on royalty at the gross level, and therefore we are applying a different percentage of income that's taxed in India. If a gross income is applied, then even on a royalty which is taxed or where TDS is done at 10% or 15% by the overseas company, you will apply the company-wide net profit margin to that income and compute your net, your foreign tax credit, which may not really be the right way to do it. Forget whether it is beneficial or not, may not actually be the right way. There are certain changes in the income tax forms, the returns, and the procedures. One first important thing, Rule 136, which has been brought in new. There is no separate form that is required to avail concessional tax rate. If you remember, today we have to file 10IC before the return, quote the acknowledgement in the return, and attach or have the 10IC to be reflecting on the portal. That's not there anymore. Even though the current return forms also required us to show whether we have exercised the option or not, there was a separate disclosure, separate form that was there. That's been done away with. So you opt in the return and there's no separate form to be made. Rule 166 covers defective return. Right now, 139(9) talks of defective return, and an explanation in the Income Tax Act 1961 to 139 actually talks of what constitutes a defective return. Interesting and surprising at the same time that we did not pick this when we read the 2025 Act very closely, that there was no definition of a defective return. The defective return section simply said that it will be defective and rules may be prescribed. Therefore, what constitutes a defective return has now been moved into a rule. That's in 166. The rule talks of what is considered defective. The first few clauses are the same as the explanation in 139.9, that if you have not filled certain sections, schedules, you have filled some number wrong, you have not attached your tax computation, the tax audit report is not filed before the return of income, all of those are there. In addition to that, there are two new scenarios or two new situations where it can be defective, which has been brought in. One, in case of updated return, that the details of tax paid are not provided, or in case of normal returns, there is a mismatch in credit claim for MAT or AMT against credit allowed in the latest return. This was never a cause for a defective return in the past. This has been brought in. Therefore, again, looking at the MAT and AMT computations and disclosure closely becomes important. Otherwise, that would again constitute or become a defective return. On assessment and appeal, nothing too significant, but it's just the way the rules are. The procedure for faceless assessment is moved into the rules. And as per the procedure for faceless assessment under draft rule 176, only a notice for initiation of penalty proceeding would be issued along with the order. Again, this is inconsistent with what was spoken by the finance minister to say that there'll be a common order and not a penalty notice. We've been grappling with how a penalty order will get passed along with an assessment order, because a penalty proceeding is always a separate proceeding. And how can you levy penalty on me for non-disclosure without having established that there is actually a misstatement resulting in a reduction, enhanced income or a reduced loss, for example. Therefore, if an assessment proceeding is happening, if an order is being passed, treating something as undisclosed income, let us assume for a minute, before you conclude that, how can you conclude that the penalty is also applicable on that, and therefore the current 270A and other things have to be done as a common proceeding. Therefore, the inconsistency between a common order which contains penalty also is even more pronounced now, because the rule 176 again clearly says that the initiation of penalty proceeding, you have to issue a notice along with the order. The form of appeal to Joint Commissioner Appeal and CIT appeals, there is a more structured documentation. The form 99, which is for CIT appeals form, proposes the appellant to file a declaration for repetitive appeals, which was always there in 158 capital A of the 61 Act. But we did not have a form which would require us to file all of this. So therefore, this form actually says if there are identical question of law which are pending adjudication, we can actually file the earlier copy on the issues decided and file that this is a identical question and therefore it is a repetitive appeal. Then there's also a need to certify that the appeal is not being filed for immunity of penalty. This again becomes critical because a lot of the times we were filing appeals on matters which we had accepted and we had paid the tax demand only to say that we will have an immunity from penalty and therefore an appeal is being filed. Again, technically penalty proceedings are separate, and whether you've filed an appeal or not for penalty, you need to have established that there's a willful avoidance and willful non-disclosure, etc. Therefore, that aside, the whole aspect of treating as let's file an appeal so that we'll get immunity from penalty may actually need to be relooked at. Now, whether that can be done by way of a disclosure in the form, you are effectively rendering a lot of court decisions, etc., not being applicable is a discussion for another day. But today, the draft forms require that the appeal is not being filed for immunity of penalty. Transfer pricing is a place where there are a lot of changes, including in the Form 3CEB. We sort of would like to spend a good 15-20 minutes on this before we get to 3CEB. First is the most important thing, the block transfer pricing assessment, which is Rule 82, has been brought in. Therefore, this block transfer pricing becomes effective. What it says is, we have just taken this as an example to put the whole rule in a graphical format. The rule is actually quite detailed, but we'll just use this rather than get into verbatim the rule. Let's take a situation of a tax year of 26-27, the first tax year that applies for the new Income Tax Act. What the rule says is that you can file an application after 6 months from the end of the third year. So therefore, the rules talk of year one, year two, year three. Year one is the year in which you are going through a TP audit. Year two and three are the next two subsequent tax years. Therefore, if determination of ALP is being done by a TPO for 26-27, that is year one in the rules. Year two is 27-28, and year three is 28-29. There is an application that you can file anywhere between the first 6 months of the end of the year three, which means for when a TP assessment for 26-27 is going on and concluded, you can choose between April 1, 29 to 30th June 29, whether you want the findings of 26-27 to be made applicable to 27-28 and 28-29. If you make this application, please remember, when you are making this application in 29 April or June, your 28-29 return is yet to be filed. But you will say that whatever applies for year one will apply for year two and three. Year two return is already filed, 3CB is already filed. Year three, 3CB and returns are not filed. Once you file this in April, what happens is, let us assume you file it in April 1, 2029 to say that I will get assessed for 3 block years. So 26-27, you had a TPO who adjusted your, let's say, software margins from cost plus 15 to cost plus 20. Then you say that I'm okay with that and will fight that as a block for 3 years, and you will make this application. The TPO has to consider that application within 1 month of us filing it to hold it as whether valid or invalid. If he is holding it as valid, then whatever is there in year one of 26-27 will be incorporated in 27-28 and 28-29 also, while passing the respective orders at those timelines. It will not be passed immediately in 29. That's the reason I highlighted, when you make this declaration, the return for 28-29 itself is not filed. Forget the question of TP proceeding being in place. Therefore, these will get taken care of when the corresponding TP proceedings for 27-28 and 28-29 will go on. When will he or she look at the validity is on the points which are disclosed in the rules, to say that the transaction has to be similar, all the functions, assets, risk performed, etc. have to be the same, and once that is held to be valid. If the TPO holds that your declaration is invalid and you can't apply it for the next 2 block years, we get an option to file an objection within 15 days with the commissioner to say that this was declared invalid, whereas I think it is valid and I am eligible for a block assessment. The commissioner has to pass an order holding it whether valid or invalid. If the commissioner says it's to be valid, then the TPO will revise his or her order holding it to be invalid to state it valid, and then rest of it follows. And if the commissioner also says this is invalid and therefore you're not entitled to a block assessment, the TPO carries on with normal proceeding. So for 27-28 and 28-29, you'll have normal proceedings. The TPO can call for information, can do a normal proceeding and pass separate orders for those years. Sorry, this also is the case after it has been held to be valid, the order is cancelled or order is held to be invalid because the TPO realizes that there is a change in fact, or that the finding of 26-27 doesn't apply to the other years. Therefore, this is in summary, and we are happy to we are working on a detailed alert on this one aspect, taking examples, etc. We will circulate that in the course of this week or next week, but happy to discuss that after we've circulated that. But in a snapshot, it's really 3 block years to be treated as one TP assessment. You need to make that option within the first 3 months of the third year ending. So 26-27, whether it has to apply, has to be made before 29 April 1 to 30th June. If by then the 27-28 will still be in proceeding, therefore that will still be open for them to make the adjustment similar to the first year. The safe harbor rules have been proposed. Rule 91, it consolidates software development, ITS, KPO, all of the different things that were there in a single category as IT services. Operating profit margin has been reduced to 15.5%. for IT services where the revenue does not exceed 2000 crores. This, I think, is a huge change, especially for larger groups with smaller operating companies, acquired entities, etc., which is a common structure that we've seen where the activities are being followed on for a variety of reasons because the employees have not been transitioned, etc. Then those can continue to opt for this 15.5%. Earlier, we were always hitting the turnover limit of 300 crores, which was too small in my view. Therefore, this 2000 crores is a big change. The procedure for application, acceptance, rejection, withdrawal has all been provided in Rule 91. A draft form 49 is proposed to be filed for exercising the safe harbor option at any time during the first 5 consecutive tax year up to the 30th June of the financial year, immediately succeeding the first tax year. So you can do it anytime during that time. This rule again, these are two aspects. The safe harbor and the block assessment we will cover with a detailed alert requires attention. And I really don't see too much changing here, even with representations or anything, because these are well drafted provisions, which in my view are beneficial as well. So I really don't see personally these two rules, these two processes changing. Therefore, we will, and we are in the process of doing a deep dive on this, and we'll come back to you. The TP accountant report is one of the most significant changes in my view. And this will require a lot more information, a lot more data to be collected, and also increases the risk profile. And I'll come to what it does in a minute. But again, this is nothing but the replacement for 3CEB. Firstly, it's been made very detailed with a lot of options which appear like a drop down or a selection rather than what we can fill. The first part of the 3CB does not change too much. All the different types of transaction reflect exactly the clauses which are the definition of international transaction. And those are just appear exactly like how the current 3CEB is. What changes is they have brought in a completely new section which talks of certain specific expenses which are there, and those have to be shown. And that is where I think we will spend time, which is really clause 14 of Form 48. Form 48 is the 3CB equivalent. Up to clause 14 is all what we are currently used to, with some minor changes, really not something that we should be spending too much time on. Of course, there's language change, it's become better, disclosure is in different format, etc. Like in 3CD. Like I said at the beginning of the webinar, really the attempt has been to spend time on what has changed rather than in real substance, rather than what has changed in small form and disclosure, etc. Clause 14 requires additional details. What you see at the middle of the slide, which is an extract, is an absolute copy paste of the Form 48 as it stands in the rules. It requires in 14 capital A details regarding certain expenses. Please focus on all the columns. Nature of expenses, amount recorded in the books of accounts, amount not recorded in the books of accounts, and the total expense, which is A plus B. See column D. The amount of total expenses in column C included in the computation of arm's length price. Column E, amount of total expenses in column C not included in computation of arm's length price. There are 7 items in this. Number 1, and those 7 we've copy pasted into the box. Number 1, stock compensation or any other bonus incentives paid by the SSE or its AE to the employees of the SSE. A clear capture of the stock compensation expenses, whether accounted or not. This is something was being done in the APA to ask for ESOP expenses if you have not been cross-charged, if the Indian company is not taken into books. Now, just look at this 14A1, 14 capital A clause 1 is stock compensation expenses or any bonus incentive paid by the AE to the employees of the SSE. And now look at clause B, column B, amount not recorded in the books of accounts. Therefore, in a case where today we are not getting a cross charge of the ESOP expenses, the amount will get reflected in B. Please remember, this is forming part of the 3CEB, which is to be certified by the accountant who is issuing the 3CEB. Same on clause 2, cost or depreciation of assets, software, tools, licenses, or databases provided by the AE including third-party software databases, licenses, and other assets or tools, as well as those developed in-house by the AE. So you're having a timesheet software, you're having an expense claim software, you are having it could be even evaluation. Your HR evaluation tool, etc., is an in-house software developed by the AE, and there is no amount recorded in the books of accounts of the Indian company. These are not limited to free of cost assets. These are assets, tools, software, licenses, databases, including those which are in-house developed by the AE. This, I think, is a significant change. Now, this does not get captured in the main 3CB, but it's there in additional details. 3, 4, 5, again, if we get into each of them, all of us will be having these kind of expenses, and these are today may or may not be captured in India. We may or may not even have full details of it. Look at 3. Cost incurred by AE towards travel and other expenses of employees of the SSC in connection with work, training, or other business purposes of the SSC outside India. Now, most of the GCCs, most of the Indian companies to send their employees abroad, where a lot of the travel and other expenses of those employees are taken by care of by the parent company or the group company in the country where they are visiting. Clause 3, 14A3 clearly captures that. It is cost incurred by the AE towards travel and other expenses of the employee of the SSC in connection with work, training, or other business purpose of India. What complicates this is really column B. Because if it was column A, it is disclosure of what's in our books of accounts. Column B is to disclose something which is not in our books of accounts, therefore, by inference, will not be available with the Indian team. 4. Training expenses incurred by AEs for employees of the SSC or management consultancy or other services provided by the AE. Training expenses, we have routinely seen a lot of large companies where whether it is LinkedIn Learning or few other things like that, or a Harvard training, etc., the subscription is taken globally, is available for employees of all companies, all presence in all geographies, etc., and the cost is rarely shared with a cross charge, because that would be hair splitting. It may not even be a significant amount, but the new 3CEB, i.e. 48, requires disclosure of that. 5 is all costs incurred by the AE on employees seconded or transferred by the AE to the SSE. So your seconded employees, where a part of the salary is being paid overseas, part is paid in India, Indian cost is getting recorded here, the overseas cost, or even, it's all cost incurred. Therefore, your 401k in US, other social security in European countries, which are being borne by the foreign company, which may or may not have been cross-charged, today get captured because that's an amount not recorded in the books of accounts. All costs relating to outsourcing incurred by the SSE or AE, any other expense incurred by the AE but utilized in the business operation of the SSE, please specify. This one clause, I think, is the most significant change from a transparency perspective on the disclosure. There's nothing in the law that was needed to be amended here. The income tax department was always calling for this information. They were calling for it in notice. Some officers were smart enough to actually ask exactly what they needed. Some of them, the questions were not very clear, though this is what they were attempting to do. What they are essentially doing here is to ensure that the cost base of India is being appropriately captured, and there are no costs which are sitting outside, which are related to this, because they have realized that that is one significant area. Once they reduce the litigation on the margin dispute with safe harbor and all other things, the cost base being captured becomes extremely critical. This is, sorry to be repeating, but this is actually one of the most important things that we'll have to spend time on, and this applies from April 1. This form, again, I don't think this part is going to get changed. This is a well thought out part of the form, well thought out additional details. There is nothing anybody can object to in this. None of us can today write back to the government to say, why are you asking for this information? Because simply, if these costs are incurred for the employees of the SSC, it ought to have been captured in India in any case. So this disclosure is here to stay, again, in my view. This will need a lot of work. This will need a lot of change, even in terms of what we have done in terms of computation of the arm's length price, etc., and what we've been used to thus far. So this is something that will need a lot more time to be spent on as we move along. So just to sum up, we believe that we should now conduct a detailed analysis of what are those centralized services which are provided by the AE to the Indian company or the taxpayer, along with review of all the global agreements with various group entities. If there are common ERPs, common software tools, etc., is there a cross charge that's happening and what needs to be done? With respect to, again, these centralized services, once we establish that there are indeed services, are they being cross charged? The explicit quantitative disclosure relating to licenses, tools, in-house tools, etc., are important, cannot be ignored. And please remember, repeating again, that this is a certificate that needs to be issued. It's an audit report that needs to be issued by accountant in Form 48. Therefore, it's not a 3CD disclosure or anything. It's actually a return disclosure in a schedule or something. This is actually a part of Form 48. And these, as we have seen, are quite commonly utilized, commonly licensed. They are availed and used, and it's a globally common structure. Lastly, the form, as you saw, requires the cost or depreciation of assets provided by the by a AE. This really is capturing all the assets received free of cost from the associated enterprise, whether the same is accounted in books or not, and whether it is included in the computation of ALP or not. This again is an aspect which the department was actively focusing and pursuing in all the APS that they were signing, both the ESOP cost and the free of cost assets depreciable value or the value of the asset. So this has been now brought into 3CB. There's another section in clause 14. 14A is these other expenses. 14B talks of grants, etc., received from government and things like that, which may not impact us significantly, but again, which may not impact the wider audience significantly, but that's another aspect which has changed when compared to Form 3CB. There are a few other smaller changes. Like I said at the beginning, there's one change relating to specified financial transaction. This applies for banks and few other companies which are involved in or part of the specified financial transaction. There's an existing threshold of 10 lakhs, which is being reduced to 5 lakhs for payment by a person not having PAN, etc. Purchase of immovable property is proposed to be taken at 45 lakhs against 30 lakhs. And it's also been expanded to include gifts and joint development agreements, which needs to be disclosed. Any receipt of insurance premium of 10 lakhs and above has to be reported. There's a change to the FATCA framework, and they have including crypto assets and other digital currency disclosure. A proposal to explicitly standardize currency conversion methodology by using RBI reference rates. This again is a important aspect because some of the FATCA issues were also happening because of the rate of exchange that was being used. Crypto assets are proposed to be included as financial assets across all definitions and meanings maintained in the entire rule. So whenever they talk of a financial asset, crypto is also included. These were, what we thought were very important changes. Thank you again for joining us. We have a few questions which have come. We will take those. But again, to sum up, looking at the ERP data localization, your backup happening in India, not happening in India, TDS provisions relating to foreign payments, AE transactions which are not accounted in the books in India. These are all critical, while these need some work. Let me just get to some of the questions that we have got. First one is, EVs are not getting covered under perquisite. Does EV get mentioned in the new rules since only CC is mentioned? Absolutely important, and funnily, EV is not mentioned in the rules. And I can see my good friend Kirtan smiling because he drives a EV, and therefore possibly, and Ravi, this is a question from you, possibly if EVs are given, we can take. I think this will get addressed, but that's a good point. EVs are not covered technically under that rule right now, but what happens is it will get covered under other assets given by the employee, and therefore a smart officer can actually take you under the residuary rule for perquisite to say that it may not get covered under motor car, then it will go under other assets which are provided. Another question, the next question is on Form 48. For instance, I do not have any transaction with international AE in subject tax year. However, AEs incurred certain expenses as per 48 14A. Do we still need to report such expenses even though there are no transactions in point 1 to 13? Again, very important and interesting question. I would think it will have to be, because what essentially the 14 capital A is trying to do is to say that this is an actual transaction. While we may be saying it's not a transaction, what they're saying is you may have not put a rupee or a dollar value to it, but the fact that AE has incurred an expenditure, provided you a software tool, it could be any of those things, is actually a transaction which is not recorded by you in the books, but is something that has to be recorded. So 14 capital A does really expand this to say that we have to disclose this whether it is in the books or not. Very technically today, an international transaction in any case is not only those which are recorded in the books, it is anything that I do with the AE which has an impact on my income, etc. So it will be there. SFT, any changes to the current 61 capital A, 61 capital B reporting? None that we have noticed which is too significant. There are, of course, cosmetic changes in most of these forms. There are cosmetic changes of the form looking different, capturing different data, etc. Some of them becoming drop down and things like that. But there's nothing significant which has changed on 61 capital A or 61 capital B disclosure. Next question is on whether food coupons can be claimed under the new regime. Yes, they can be. How the expenses of AE be verified by tax auditor? So the expenses of AE technically will not be verified by the tax auditor, but really by the person who is issuing your Form 3CEB, the current 3CEB. Again, how the auditors will put a system in place for this, I'm really not sure. Going by what the practice has been on transfer pricing, and pardon me for, it'll actually by way of a declaration or a disclosure by the taxpayer. It'll be part of your management rep letter, etc., to say we have disclosed this, not disclosed this. I don't think anybody here can look at all the expense line items of an overseas company, understand what is there. So therefore, it again becomes critical for us as the taxpayer to actually have, all of this information readily available. One other question. Are they open for auditing the corporate tax matters too, similar to joint TP audits, assuming if the facts have not changed significantly, more from a time-saving standpoint? Very, very interesting question on the whole block assessment of 3 years, whether it can be done for corporate tax matters. Very technically it can be, and today it can happen with 158 capital A, which is also there, which is to say that if it is repetitive appeals. But those are only if the same question of law goes on the other years. Why it may not come to transfer pricing in my view is because, corporate tax in my view, because transfer pricing assessments, whatever be the situation, are on a very limited point, which is on the arm's length price, no other thing. Therefore, there can only be very technically only one issue. Whatever audits we may do, the transfer pricing officer will only comment whether it is at arm's length price or not, and what adjustment needs to be done for the arm's length price. Whereas a corporate tax issue can be multiple things and change each year. So 1 year it could be a tax holiday, another year it could be an expense claim, another year it could be, on depreciation, asset capitalization, revenue recognition. Therefore, it may be very difficult to bring in something like that for a corporate or a regular assessment. The next question is, other major area of Form 48 is about asking the export incentives and forex separately to bring the operating versus non-operative dispute very clearly. Completely agree. Krishna Kumar, this is a fantastic point. I think this is in 14B, which talks of what are the export incentive, etc., and the forex, which is separately to bring the operative and non-operative dispute. We had not specifically covered this on whether this was impacting this operating, non-operating dispute. I think this is an important point. 14 capital A we discussed at length. 14 capital B is what Krishna Kumar is talking about, which is really disclosure of expose incentives and forex, which a lot of the companies have claimed and to be non-operative, and therefore if there's a loss you actually claim it as a non-operative expense and get a benefit of the rate on that. One other question: if there are changes in the old scheme, then is the government intention to keep the old scheme relevant? I am really not very sure. This was the first thought that I had also when they changed the HRA thing, because the finance minister has been quite vocal to say that we want people to move into the new scheme. And they are also disclosing data of how many people have moved, etc. And I also always thought that they were nudging people to move to the new scheme, which is what they did with this MAT extension in the current budget announcement, to say that even companies which are hesitating to move into the new scheme because of MAT, I will give you the MAT credit, please move into the new scheme. But this HRA change really looks like a little bit of going back on that one thing. But I think their stated intention remains to promote the new scheme rather than the old scheme. Those were the last of the questions. Oh, there's one last one. Any update on ICDS accounting standard alignments in the new rules? No. There is nothing which is different from the existing rules and forms on ICDS and accounting standard alignment. Thank you very much for this. This was our first attempt at doing a webinar only for the clients we've been working with, and it's been it absolutely heartening response, and so many of you joining. Thank you so much, and we'll continue to do more of these. Thanks again.